Well, the markets are way ahead of themselves in terms of where we are, I can tell you, because we decide meeting by meeting, so we're not at November yet at all. We've got a program of quantitative easing, which coincidentally is 100 billion as well, going on. That will go on until round about the end of this year. Its trajectory takes it through to about December. That's in place, and when we get to November, we'll take a fresh look at it.
The view on negative rates seems to have confused people. I looked at George Buckley over at Nomura. He said the bank has ruled out negative rates. I look at other analysts who say you've put it in the toolbox now. Can you give us clarity as to whether we will see negative rates next year?
No, I can't. I can't give you that because I would never give you a judgment on what monetary policy is going to be a year ahead before we get there. What I can tell you is that other analysts are essentially right in the sense of saying it's in the toolbox, but it's not. There is no plan at the moment to bring it out of the toolbox and put it to work. We have no plan to implement negative rates at the moment, but we've spent a lot of time over recent months looking at the toolbox and looking at negative rates. We've looked at the experience of other central banks. They've used it. A lot of continental Europe obviously is either using them at the moment or has used them. A lot of useful evidence and experiences. We've talked to other central banks about it. I think there is a close relationship between the effectiveness of negative interest rates and the structure of the banking system, particularly the amount of retail funding, and also the point in the economic cycle at which they've been used in different countries. So there's a lot of conditionality in there, if you like. But I think looking at that and looking at our situation, it makes sense to say, look, we need as many tools in the box as we can get at the moment, because obviously we're in a constrained position with interest rates as low as they are. I think it makes sense to have them in the box. But I would also caution anybody who thinks that that means we're about to pull them out of the box and put them to work. That is not what we're discussing at the moment.
Obviously, you've talked about the history of negative rates with reference to other countries. Would you dispute the argument that says that actually they failed in Japan or in Europe to develop above-trend growth rates?
Well, I mean, it's interesting because there's a lot of work being done. A lot of work being done by the central banks. I think the judgment on what they've done and what they've done to trend growth rates is obviously a complicated one to make because it depends on the situation in which they're done. Let's be clear. Trend growth rates have been falling in many countries for quite a long time. I mean, they have in the UK, for instance. And a lot of that is to do with structural developments in the economy. A lot of it is to do with weak productivity growth. It's not to do particularly with monetary policy, particularly. Monetary policy is not the obvious tool to tackle structural questions with. I think that the judgment, though, is to what extent have negative interest rates helped? And I think if you look at very good work produced by the European Central Bank, for instance, in its assessment of its own experiences, and other central banks, Sweden, Denmark, Japan, I think it's a very mixed picture, to be honest, that comes out of that work. And I'm not surprised by that because it depends on the context.